Hello, Finimizers. Welcome to another Finimize live event. I'll just wait a second. I can see the number of participants rising, so I'll just wait a few more seconds. Keeps rising. That's great to see. Hello, everyone. Welcome. Okay, great. So my name is Stefan. I'm a global analyst here at Finimize, and I'm extremely happy to host today's event with our partner, State Street Investment Management. Before we start, just some very basic housekeeping rules to run through. In terms of format, it's going to be a 15-minute discussion followed by a 15-minute audience Q&A. We will use the chat box to tell you when it's Q&A time and add some important links for you today. So just remember to keep an eye on it. And lastly, use the Q&A box to ask a question. And if you see a question you like, upvote it so it moves to the top. And that way we can get through the most upvoted questions first. All right, so let's get started. So today's session is brought to you in partnership with State Street Investment Management. If you're not familiar with State Street, they draw from their global scale and market-tested expertise to help create original solutions and better outcomes for their clients and world's investors. For more information on their full list of ETF products, market insights, investment ideas, and ETF education, you can visit them with the link in the chat. statestreet.com/investment management should appear now. Perfect. Now, of course, no finance event is complete without a very quick disclaimer. Your capital is at risk. This isn't financial advice. Tax treatment depends on your individual circumstances and may be subject to change. Okay, with that out of the way, I'm very pleased to introduce today's guest, Michael Riggs, CIMA Senior Strategist at State Street Investment Management. He serves as a subject matter expert in ETFs and portfolio construction. And in this capacity, he performs economic and market research used to generate strategic and tactical investment opportunities across asset classes. Before this, he led a team responsible for attribution and analytical reporting for State Street's institutional clients. So he's no stranger to turning complex data into smart decisions. He holds an MBA from the University of Massachusetts Amherst and a Bachelor of Science degree from Bridgewater State College. He also holds the CIMA designation, and yes, he's passed the dreaded Series 7 and 63. So safe to say you're in very good hands today. Michael, absolute pleasure to have you with us. How are you doing today?
Hello, Finimizers. Thanks for having me today. Great to see everyone.
Love the energy. All right, so let's dive in. So on the screen, you should actually see a poll to kick things off. Perfect. Take a look, give a vote, and we will look at the results right before the Q&A. Okay, Michael, let's get going. So my first question is, what's one important trend or dynamic in the US market right now that most investors are missing, but smart investors should be watching closely?
Yeah, I would say if there's one thing you take away from this call today, it's the understanding that the main driver of stocks long term, the main driver of price appreciation of stocks long term is earnings growth. That you need to actually completely understand that and to become more comfortable with investing long term. There's a lot of noise. Short term, a lot of things can drive stocks. Discussions around tariffs, unemployment, inflation. But long term, it truly is earnings growth. And that's what you really want to focus on overall within investing is earnings growth within your investments and whether it's growing. Historically, to put it in context and that so everyone understands, over the last 60 years, earnings growth rates within the US large cap market have been about 8% per year. So this means companies have grown their profits on average by about 8% per year. And the price return of the S&P 500 annually over that time frame is also about 8%. So you'll see they tend to follow in a very coordinated fashion as earnings growth rates or the expectation for earnings growth rates expand, price appreciation happens. And so that's the most important consideration because there's a lot of noise, but all that noise boils down to is earnings going to be higher than it was next year than it is this year? That's the most important thing to remember.
Super interesting. Okay, so now for the second question, we're going to talk about large caps. They've had a very strong run, but you say that they actually still deserve a place in your portfolio today. So why? Why should Finimizers consider investing in large caps in this kind of market?
Sure. Well, let's first define what large cap is. So historically, at least as defined by S&P and Dow Jones, which are our partners, large cap companies have market valuations or market capitalizations north of 22 billion. So this is basically the low end of what we consider to be a large cap stock. So let's put that in perspective. So 22 billion is kind of the entry point to become a large cap stock. Let's look at a few companies. Lululemon, for example, its market capitalization is right around 25 billion. Nike, about 106 billion. Walmart's about 750 billion, so 750 billion. And the largest company in the world, which is Nvidia, is about 4 trillion. So it's a very wide data set as to what determines large caps, but historically it's those companies, as of today, have a market cap of more than 22 billion. This segment of the market is by far the biggest segment. So if we were to look at the entire US equity universe, as defined by Standard & Poor's, the large cap space would represent about 90% of the value of the investable universe. So just by definition, large caps are the biggest component of the US equity universe. And as such, they should be the biggest component of your portfolio. Not only do they make up the largest majority of the market overall, but typically when you think of large caps, you think of companies that have great brands, have strong earnings growth, have a strong history of paying dividends, typically more safer than small caps. So simply by definition, large caps make up the biggest part of the US equity universe, and they should make up the largest portion of your portfolio. The last thing I'll leave you with is at State Street, when we run model portfolios today, in our most aggressive portfolio, large caps of our entire US equity universe, large caps make up about 80% of our investment, another 10% in mid caps and 10% in small. So that's the reason why. I mean, they're the biggest part of the market, and so they should be the biggest part of your portfolio.
Awesome. Now let's make it actionable for our Finimizers. So, the market is really I mean, at least headlines are really dominated by the magnificent seven companies. So what's your playbook for spotting undervalued US stocks with, significant upside over the next 12 months?
Sure. Well, this is the holy grail of investing, right? This is why Warren Buffett exists, really, is to find undervalued stocks overall. Let me first tell you what not to do, though. Let me first tell you what not to do. Never catch a falling knife. So don't consider undervalued stocks as stocks that, say, have fallen 50% in value over the next year or over the last year. I think Peter Lynch, the legendary investor, said it best. He said, just because a stock has fallen 50% doesn't mean it can't fall another 50%. So again, undervalued doesn't mean it's fallen from significantly from its highs overall. In my playbook, I like to look at a particular segment of the market or a particular catalyst within the market that has not been priced in. So if we were just to talk about artificial intelligence, well priced into the market, especially for some of the mega cap stocks overall. Everyone's talking about it. It's priced in. But let's think about some catalysts. You want to think about catalysts that really haven't been priced into the market overall. Our research team, for example, believes that for financials, the catalyst of deregulation. So this current administration would like to deregulate the banking industry, really means they don't want to have some of the constraints they have on how they make a profit, potentially loosen some of the regulatory constraints that cost a significant amount of money and reduce overall net profit. But if you look at financials and banks valuations compared to the broader market, they're actually at almost at 15-year lows. So we don't, in this case, the catalyst is deregulation within financials. We don't think it's been priced into the market. And so that might be a catalyst for an undervalued area of the market. But again, don't think that simply because an area of the market has fallen significantly that it's an undervalued stock. Again, a stock that's fallen 50%, there's no reason why it can't fall another 50%. So look for a catalyst within a market segment or a stock that you don't think has been priced in. Look for something that's reasonably valued, meaning if you compare it with other industry components or other industry companies within that industry, that it's not super overvalued versus those peers within the marketplace. So reasonably valued and a catalyst that hasn't been priced in. That's kind of my playbook for finding undervalued stocks in the US. But it's really not based on metrics such as PE or price to book, et cetera. It's really based on the idea of a catalyst not being priced into the market today.
Love that. Super clear tips. Thanks a lot for that, Michael. So now what signals, economic signals or sentiment or anything else, are you watching right now to know, whether it's time to dial up risk a little bit or, maybe lean a bit more defensively on US stocks?
Sure. I'd love to give you, some great free research out there that's available either from the St. Louis Fed or the Conference Board or other government entities that can provide really some great tools and tools that we tend to look at when deciding whether to lean into defensive areas of the market or lean in more aggressively. So let me start with the very first and probably the most well-known. It's called the Conference Board Leading Economic Indicator Index. And so if you just Google that, it will bring you to the Conference Board website, and it will show you basically that index and the components that make up that index. This is kind of an aggregate index of leading economic indicators. So they basically are leading the business cycle by about 7 months. So the 4 phases of the business cycle tend to be expansion, peak, contraction, and through. But the leading economic index looks really at 10 different areas of the market. It looks at average weekly hours earned, the S&P index, the credit index, and spreads between high yield and U.S. Treasuries, overall manufacturing orders, etc., unemployment and building permits. And it kind of aggregates all of these numbers into a single number and will give you an idea if the expectations are for the economy to expand or contract. Right now, it's kind of in a gray area. It's actually turned a little bit sour. Part of that has to do with unemployment claims rising and orders on new manufacturing falling. So that's the first one. Again, you can just Google the Conference Board Leading Economic Index, and it will pop up in Google. Okay, my second favorite is really, we discussed what the big primary drivers are for equities over the long term, and that absolutely is earnings growth. I love to look at the trend of earnings growth versus the trend of the price growth of large cap stocks. It can be either the Dow Jones Industrial Average, DIA, or it can be the S&P 500. But if you Google FactSet Earnings Insight, there is a great chart that is tracking the trends of earnings growth and price. And when earnings growth starts to get well above, or when the price starts to get well above earnings growth, it's an indication that the market is expensive. And this has been a very good chart to kind of get an idea of, okay, is the market expensive given the last 10 years? And if so, maybe I don't want to aggressively continue to invest in the market. I might pull back a little bit. I just love this because I do think it's, again, the primary driver of stock returns over the long period are earnings growth rates. So FactSet Earnings Insight, a great chart. Again, it will show you the trends of price return of the S&P 500 versus earnings growth. When price return starts to deviate from earnings growth, it tells you that the market is getting a little bit expensive. So again, another free resource. I think it's a great tool. It does get a little bit into the weeds on earnings growth rates across sectors, but again, a great tool. And the last one, again, one of my favorites, is called the SAM Recessionator Indicator. So SAHM. SAHM. If you Google this, you'll be brought to the Federal Reserve website of St. Louis. And this is a leading indicator of unemployment. So historically, unemployment's a lagging indicator, but Claudia Sam, who is a Fed economist, created a coincident or leading indicator called the SAM Recessionary Indicator. Basically, it looks at current trends in unemployment versus short-term trends in unemployment versus longer-term trends. When the short-term trend starts to deviate by about 50 basis points over the long-term trend, it's been a very good signal for the start of a recession. So that's another indicator I look at because I do believe unemployment is one of the most important economic signals in terms of business cycles and recession overall. So I'll repeat those again. Conference Board Leading Economic Indicators Index. That's one aggregate of 10 different economic indicators. Two would be FactSet Earnings Insight. That's going to show you the trends of earnings growth over price growth. And when earnings growth starts to deviate, or when price growth starts to deviate from earnings growth, it's telling you that the market is starting to get expensive. And the last is the SAM Recessionary Indicator, SAHM. That is an indicator for of recession. When short-term unemployment gets to be above 50 basis points over intermediate term, it's been the signal for the start of a recession historically. So those are typically tend to be some of my go-to indicators that I look at.
Amazing, super comprehensive and very well explained. Thank you. So now it's time to turn to all of you tuning in for Q&A. So please ask your questions in the Q&A box. Vote for the questions you want to see answered first. Okay, so let's start. Okay, actually, first, the results of the poll. Do you currently invest in any of the following large cap indices? I think we have a clear winner, S&P 500. Not that surprising, I would say. Russell 1000, 11%. Other, that would be interesting to know what these others indices are, 16%. Or I'm new to large cap investing, 13%. Interesting. Okay, let's move on to the question. So, how risky is Nvidia during this tariff war as they resume their sales to China? I think we got the news earlier.
Well, that was the big impediment. So the big impediment was Nvidia. A majority of their sales, or a significant portion of their sales, was to China, and the current administration really wanted to kind of close down the idea that Nvidia could sell its most advanced chips to China. As that tends to open up, it's really a major tailwind for Nvidia overall, because China is a massive consumer of Nvidia products, and it will continue to be a massive consumer. So yeah, it's a major tailwind for Nvidia. I would just let you know that Nvidia has absolutely been on fire. But to the point I love to make, why has Nvidia done so well recently? It's because we'll just take 2024 as an example. The entire U.S. equity market earnings growth was up about 9%. Nvidia's earnings growth was up 600%. So that's what's driving. But yeah, it's major. If they can open up sales to China, it means a tremendous amount for forward growth for Nvidia going forward.
Awesome. Next question. How sophisticated an investors do you think someone needs to start utilizing these indicators as a retail investors?
Yes. So I'm not advising that you use these indicators to either jump into the market or jump out. They're simply a way to gauge where the market is headed, or what the consensus is kind of on market sentiment. I never advise for jumping in or out. These are really indicators to look at to decide whether you want to maybe lean towards defensive areas of the market, such as utilities, um, or consumer staples, or maybe lean towards more aggressive areas of the market, such as technology, overall. They're not perfect. These are not perfect indicators. They're really just to give you a gauge of what the market is feeling and to give you a starting framework for how you might invest. So I would say, if you can read a balance sheet and you can read an income statement, then absolutely go ahead and start to consider those indicators maybe as part of your framework for investing. But if you're not comfortable, then they're just ways, I think they're just tools to look at to get an idea of what the market's kind of thinking in general, overall. But again, unless you're comfortable reading a balance sheet or an income statement, I would not use them as tools to either get in or get out of the market.
Okay, maybe you're not gonna like that next question then, because it's another question on this, on specifically how you use those indicators, which is basically how do you weight the importance of those three indicators? If one indicates a potential issue, but the others still look okay, what do you do?
Yeah. So I would say my primary indicator is going to be earnings growth versus price growth. And again, if you look at that, you can clearly tell that the US market is very expensive given history. And as a market gets more expensive, it simply means the forward returns are not going to be as attractive as the prior returns. So I would say my primary one is simply looking at earnings growth rates versus price appreciation. And that gives me an idea of, hey, is earnings growth driving this expansion, or is the market simply getting more expensive? The second is going to be leading economic indicators. I will tell you, this hasn't been a great signal recently. I mean, I would say over the last couple of years, it has taken a very negative dive, but yet the US equity market has still performed really well. But again, it's a gauge, it's a signal to just see some of the variables that go into driving growth rates within stocks, how, what direction they're heading. And clearly, from leading economic indicators, that direction has been somewhat south. So it's been somewhat negative, but it really hasn't been too much of a headwind overall. And then third is the SAM recessionary indicator. I do believe unemployment in this environment is probably one of the biggest keys to recessionary risk. If we start to see unemployment grind higher, typically it's a signal that the economic environment is starting to sour. So first, I would put the earnings growth rates, FactSet Earnings Insight. Second, Conference Board's leading economic indicator. And third, the SAM recessionary indicator.
Just a quick follow-up on that. If you look at the price difference compared to that earnings growth, that will, feel a lot like valuation in a way, right? Like the difference between the two. So do you think this is actually a better valuation indicator than, the traditional P ratio of the index, for example? Like, do you think this is something that really provides something different, or would you actually use it in conjunction with more traditional value indicators? What's your view on that?
Sure. Well, actually, is the PE is what the FactSet Earnings Insight chart is, but it's a visual chart. So if I were to tell you the PE on the Dow or the S&P 500 is north of 20, and I'll just quickly explain what that means. It means it would take you 20 years to get back your investment for the earnings that company makes. So again, the bigger the multiple, let's just say it's a PE of 30, that means it would take 30 years to earn back the primary investment through earnings growth. The FactSet Earnings Insight piece literally it's like PE. If you look at it's basically the average PE over what the current PE is, but it's charted. So it's more of a visual. So instead of just saying the PE of the S&P 500 today is 24, it's a visual to say how it has expanded over the last year or so to give you an indication of hey, how does this look versus the last 10 years? And if you look at the chart, basically it's telling you over the last 10 years, which have been very good years, we're at one of our most expensive levels we've ever been. Um, Given history, the average PE has been around 18 or 19 of the S&P 500 over the last 5 years, and today we're trading at 24. So it literally is the PE. It's just another way of looking at it.
Nice, love it. Very interesting next question. Would you say right now that large cap US stocks, how do they compare to international large caps right now, in terms of risk adjusted returns, potential returns, and any other countries or markets to watch?
Sure. Yeah. So year to date, international is really doing well. It's actually trouncing the US. But a big driver of this is a weaker dollar. So remember, when you own an international investment, you are literally selling dollars and buying euros, Japanese yen, and Australian dollars. And the dollar has weakened about 10% over the last year. So that has been a big driver overall of international stocks. Um, can that continue? Our estimates, we've actually taken some chips off the table in international. Part of that has to do with earnings growth rates in developed countries. So that would be Europe and Japan, Australia, et cetera. We think earnings growth rates are going to be below US earnings growth rates next year. And again, as I mentioned, earnings growth rates are a big driver. Economic growth is also going to be much slower in Europe and Japan than it is in the United States. We expect GDP growth rates to be around 1% in Europe and Japan, more like 2.5% in 2026 for the US. So we're actually favoring the US based on really two major ideas. One, earnings growth rates will be higher in the US, and two, economic growth will be higher in the US versus developed. For EM, while EM growth rates in earnings look to be higher, we do think that the dollar only has about another 10% of depreciation to go to reach fair value. So again, we think a lot of the money that was made from a appreciating dollar has already happened, although we do think fair value is another 8 to 10% lower than where we are today. So it could be a component. We're overweight the US right now. So just to give you one quick framework, in a 100% equity portfolio, we're roughly about 60% in US stocks, roughly around 40% in international from a very broad perspective, which is high for most people, but that's where we currently are in some of our models.
That's great. Actually, that sort of answers one of the next questions. So let me ask you another very practical question. Are you comfortable naming which large cap stocks you see as pushing valuations to unrealistic expectations?
Yeah. So the one big driver of the overall S&P 500 being at 24 has been the Magnificent Seven. It doesn't mean you're overvalued though. Last year the Mag 7 had growth rates of nearly 50% in aggregate in terms of earnings growth rates overall. So while they're expensive, I wouldn't say they're pushing levels that are outrageous. Something like a Palantir, though, that's trading at 50 times revenue, that's a little crazy. So the only one I can think of currently that's just trading at a valuation that is in the outer atmosphere is something like Palantir. But the Mag 7 itself, while yes, expensive given history, NVIDIA, Apple, Amazon, it's been justified by the earnings growth rates there overall. But the company like Palantir is the first one that comes to mind where I think of something that's just, in the stratosphere in terms of valuation.
And now one last question, and I will please ask you to answer it in 1 minute to make it a bit more challenging and also to finish on time. What is a simple ETF portfolio you would recommend as a core strategy? Thinking about portfolio allocation.
Sure. Yeah. So look, you can't go wrong with starting with the S&P 500 and then maybe owning a little Dow Industrial Average. Remember, the Dow is 30 blue chip names that are among the finest companies in the world. But to start with, The S&P is really a terrific diversified allocation that will give you broad exposure to the overall US equity market. Another one might be a ticker I could give you is SPTM, which is our total market index. That's a combination of large cap, mid cap, and small cap. But starting there as the core, you really can't go long as long as your time frame is long term. And when I say long term, I'm talking 5 to 10 years.
Awesome. Unfortunately, I see that it is already time, so unfortunately we have to leave it here. As you leave the event today, a pop-up survey will appear on your screen. Please take a few minutes to let us know what topics you're interested in hearing about at future events. Michael, it was extremely insightful, and you've explained everything extremely well. So thank you so much for that. Thank you everyone for joining us, and I look forward to seeing you in the future. Thanks again.
Thanks, everyone. Have a great day.